Hello, everybody. Welcome back to the Tokyo FinTech podcast. Today, I welcome David Packham, who's the founder and CEO of EOS42 and Chintai. Hi, David.
Hi, Norbert. Great to be back. How's everything going?
Very good, thank you. As good as it can be in this pandemic.
Absolutely right. I think we're all changing our lifestyles right now in terms of getting used to working in a completely different way.
Yeah, so we had you maybe 18 months ago with the Tokyo FinTech Meetup, as we don't have a very active EOS community in Japan. And so you were talking us through the state of EOS and what you were up to with EOS42 at the time. I think you were still in London. Now you're on the East Coast US. So that's a big move. Give us maybe a brief recap how you came about doing EOS42 and the journey since.
Yeah, absolutely. So I started off very much looking at the application of distributed ledger technologies, blockchain, through the prism of my background in fintech as well, which you and I obviously very much share from our time at Goldman Sachs as well. And I was looking for a platform that was scalable enough, a blockchain protocol that could handle high performance, full on-chain trading, because I wanted to actually build out an order management system that could be fully on-chain as one of the earliest ideas for a platform. I was looking at the sorts of exchanges that existed in crypto, and they were very much centralized, prone to hacking. They didn't really offer any conventional advantages over the existing. And it was from that, though, that I started exploring some of the newer protocols beyond Ethereum and came across EOS, which was ahead of its launch. And from that sprung EOS42, which was one of the launch validators that launched back then, I believe its market cap was about $10 billion US, about 2.5 right now, but a multi-billion-dollar blockchain, public blockchain. We were one of the active top 21 validators on that chain for the first year. And since then, the model seems to have largely evolved out into being more one that where people are demanding staking rewards that are, I think, more comparable to the likes of Tezos, Algorand, and Cosmos and others. And so it's moved actually to more of a kind of vote trading model at the moment, which may, I think, change again. But subsequently, we've moved into a standby position, and our focus has largely moved across to Project Chintai, which I'm sure some of your Japanese listeners are going to appreciate is a word that means lease in Japanese. And that is actually what Chintai started out being, a token leasing exchange for EOS. So I leveraged the opportunity of setting up the launch validators and the income that came from that to build out a technical team and to build the first fully on-chain order management system for EOS itself. With that, we were able to handle high-performance order management and handling for trading of CPU capacity on the network. So people were able to hold large numbers of tokens and for the first time then sell on that CPU capacity to applications and other high users and receive passive income. So that launched in October 2018 and was a very successful first year of that with the exchange. We did about $500 million worth of trade volume. About 77 million US in leasing income was traded on the exchange in year one. And then the entire exchange was taken down for a 2.0 upgrade. And what we very much did was started to look ahead at, this was just one small use case. What else actually was an order management system of these capabilities possible to be utilized for? And the answer is an awful lot. It's able to be leveraged for issuance of digital assets. It's able to be leveraged in compliance to enable, which is obviously becoming a very big deal, I think, in this space now, belatedly. And it's able to be used for market making and launching for a wide range of underlying assets. And with that, we've all been moving more to a business-to-business model, whereby the underlying Chintai technology itself is going to be white labeled and licensed out by other companies across a wide range of industry sectors to deploy those out. So, for example, we've got a lot of work ongoing right now with tokenized real estate, which is becoming a very big deal in Australia, Dubai, and areas of Asia and the US as well. And we have a client, for example, there that is going to be leveraging the platform for that. Another one is commercial real estate. Somebody wants to set up an effective way of tokenizing timeshare access into existing commercial real estate. Quite interesting to see one of the first big businesses looking at how do they respond to the COVID-19 epidemic and this fundamental change in how real estate changes. So what we've eventually evolved to, just in summary there, is moving away from being a pure token leasing exchange to that merely being one small subset of a wider suite of issuance and secondary trading and markets. And with that, we've got our own application ongoing with the Monetary Authority in Singapore and a legal entity there being set up. So it's exciting times. A lot's been happening since we last caught up with you, but we have primarily, I would say, more evolved into being more of a conventional software fintech business than necessarily just a validator as we first were when we first first talk.
So with the MAS application in Singapore, though, you are not positioning yourself purely as a software technology provider. You're also then aiming to have your own exchange. So it's a bit like the NASDAQ model where you have your own, but the software that you use to run the exchange, you can then also white label for others.
Yeah, that's a very good comparison, actually, and absolutely right. But by getting the full licensure within Singapore, we will also be able to handle things like being able to write to the underlying share registry on the DeFi chain that we're going to be basing all of this on. So only certain participants will be able to write to share registries, be a transfer agent, as it were. We'll also have the ability to handle custodial solutions over time as well for clients. I see it as quite encouraging that the likes of Brookfield Asset Management have approached us with $500 billion as they do under assets under management, because they have started to look ahead and see some of this tokenized real estate transactions starting, some of these early test examples. And I think a lot of big companies like that do see the potential of this, and they're keen to experiment at the very least, some of the more open-minded ones. From our point of view, therefore, quite interesting seeing that the opportunities all around us as it starts to build out.
The use case on the real estate for like office hours is super interesting one, right? Because you can overlay this straight into an Airbnb, which is like no different. And the issue that we're facing with these platforms is that they take a large cut of the revenue. 30% is the fee on Airbnb, Uber Eats, etc., which quite honestly is outrageous. It's even worse than any credit card fee. If you're able to trade these shares and trade reservation at a much lower cost, then that can go back into the ecosystem. And that is ultimately the original idea of this whole decentralization thing.
Oh, absolutely. Yeah. You make an interesting point in that model is extendable out to disrupt the likes of Airbnb, where they've got a cozy monopoly right now, largely on the marketplace. By having an underlying solution that can be leveraged by others, what we anticipate happening is that multiple vendors come out and set up their own marketplaces within this, but actually there's the ability to share the liquidity pool in many cases too between those markets too, via all leveraging the same underlying technology. And that would be my ideal, actually, would be frankly that no one company, for example, owns a particular marketplace, but rather there are competing marketplaces, but we don't suffer that fractionalization of the liquidity pool that comes within that, if that makes sense. So I do hope that that is what happens. I mean, certainly initially this client utilizing Chintai for the tokenized real estate timeshare model we're talking about, but really there's not going to be anything to stop other participants coming in and saying, like you, exactly as you say, well, these are now freely tradable tokens. Therefore, we can also market make and set up a competing market here and charge lower fees, for example, for access to this. Now, some people may wish to design a system that's more proprietary where you can't move tokens cross-market. And in fact, I would expect that to be the case. But logically, over time, what we should see is more competitive, decentralized models where you're effectively able to bypass that centralized control and reduce the underlying margins and cut being taken by these middlemen, because you're right. I mean, right now, you look at the likes of Airbnb, they don't have enough competition quite clearly, hence they're able to get away with what they're doing.
Going back to a bit of the market positioning, if you look at it as primary market issuance, and you have then secondary markets, private markets, and public markets, are you positioning yourself across all of these dimensions?
I mean, ultimately, we're being led by the marketplace. So if you'd asked me a year ago, for example, I thought that the NFT space was potentially going to be one of the big things in 2020. NFTs, for those not familiar, are non-fungible tokens, and they're particularly large, for example, in the commercial gaming sector, which is a multi-billion-dollar industry. And it started obviously with things like CryptoKitties, this idea of a tokenized digital asset. But within games, they have a lot of utility too, whereby you can rent a sword or something else, and actually these kids are prepared to pay a lot of money for skins and different digital assets. Moreover, with our platform, you had the potential then to also add in leasing into these too, where you could generate ongoing income from your digital assets. Other gamers that wanted to lease them out. It is still a compelling use case, but actually is developing out much more slowly than we had originally anticipated. Whereas, as an example, tokenized real estate is totally driving us forwards. We have 3 active clients who we're in talks with about building out and doing something with them. That's really how we're largely approaching this. We're letting the market demand help drive the direction that we focus upon. We do have conventional securities issuance and bonds in the pipeline. That's planned for once the MAS licensure is completed. But to a large extent, we are letting this be driven. So to some extent, it's, in answer to your question, therefore, it's all very much going to be driven by demand.
And so real estate seems to be, I think, across the board almost now the hottest topic. We've certainly heard it from Tezos, for example, working in Thailand. We have new regulation in Japan as of May 1st that addresses security tokens, and there's a lot of teams working on using that also in the real estate sector. So watching that space very, very closely, I think.
What appeals to a number of individuals, I think, and this is me speculating somewhat, if we look at what's going on globally right now as a result of the economic consequences of both the 2008-9 crash and now the pandemic, we're seeing more quantitative easing again, and we're seeing a large amount of capital being effectively printed out to fund the economies during the shutdown, which is over time, when you then compare it with tangible assets, you could argue precious metals, Bitcoin, and of course real estate. Logically, you're going to see a higher and higher demand for more effective stores of value than ones that are depreciating over time in every day in your pocket. And as awareness for that grows, logically that's going to lead to an increase in demand for people, particularly I think from younger investors who are feeling, should we say, not particularly well serviced by the system, by the idea of putting money into a government bond where you're being given negative interest rates over the next 5 years. Doesn't really seem like an appealing model to me. And you contrast that with real estate, which ought to appreciate quite dramatically over time versus fiat, this more plentiful fiat in the system. I think that's the sort of thing that's going to drive both demand for an asset like real estate, but also it's then the affordability aspect, which is because of how illiquid real estate typically is, it's one of its biggest drawbacks. Whereas by tokenizing it and having this ability to effectively therefore trade it in a more liquid form and enable particularly, should we say, millennials, for example, to go in and actually buy a $50,000 stake, a $10,000 stake in a prime piece of real estate somewhere rather than having to buy all of it and know that they can exit fairly rapidly too on a secondary market, that's a much more appealing asset class. So I think it's those kind of core drivers that will probably lead to this sector booming out over the next 2 to 3 years.
Making an asset tradable, as you said, doesn't necessarily mean there is a liquid market for it. And there's certainly people out there who are a bit skeptical that there will be a deep market. For example, if you look for alternative assets, why wouldn't you just buy Bitcoin, for example? Why would I trying to figure out what type of building I own a fraction of? But clearly there seems to be a market out for that, or many other people seem to think there's a market out for that, and your client base clearly suggests it's real demand there.
The Lakiba Group over in Australia, who we've been in talks with as well, they actually carried out by one of their subsidiary companies called Bricklet the first ever fractionalized real estate sale of an office block in, I want to say New South Wales in Australia, I believe it is. They actually divided up the office slightly crudely, I would argue, rather than full tokenization. It's not based on blockchain yet, the technology, but they fractionalized it down to, I believe, 50,000 Australian dollar tranches, and they sold out the entire building within 24 hours, which is something that was fairly unprecedented. Normally, it would be something that would have taken a couple of months to sell. They believe that's quite a powerful proof of the underlying demand. What they don't yet have, for example, is a secondary market or a way of necessarily effectively trading that out yet. But I do think, yes, there is definitely a tangible demand for this. And I think with regards to that question on the market making side, we are going to need a market like this to be quite well coordinated in terms of its overall launch. It's going to need some substantial industry participants. It's going to need market makers who can come in as guarantors of liquidity, for example, for a 18-month, 2-year period. And it needs to be handled at the legal level and the jurisdictional level appropriately too, so that token transfer is actually meaningful. Because otherwise, I mean, you and I could sit here and tokenize the Empire State Building right now, issue it out and tell everybody it's the Empire State Building. But of course, if it doesn't have a legal reflection, it's not really meaningful. The sorts of challenges we're working through in these early discussions. We'll be launching a sandbox environment once the licensure is completed, and a number of financial institutions will be entering tests with us. We can work through some of this to ensure that there's a successful market launch.
In the Singapore context, I think in the prior conversation you said that you approached the MAS and wanted to get into the sandbox, but they directed you to go for the license directly. So they seem to be pretty comfortable with the approach you're taking.
We're very fortunate to have a partner at Pinson Mason, who are one of the world's top 100 law firms. He's our general legal counsel as well, and Tom Bicknell has been doing a lot of research into this and has opted to actually go back to them and request that we go into the sandbox despite their preference. The reason they had recommended we bypassed is because we couldn't evidence to them any way we didn't feel we could be compliant. That, however, is not the same as necessarily wanting to participate and have other industry participants come in with us, and actually, particularly when you're working working through some quite disruptive or cutting edge new ways of assets trading, it is advantageous. And additionally, it gives us the opportunity to ensure we get a more comprehensive licensing with additional rights attached to it than the rec bypass we were looking at. So we decided we're going to go that route anyway and enter the sandbox. It's the right way to do things. It ties into, we're in the middle of an equity raise, commenced in fact just around the time the COVID-19 pandemic kicked off. So, it gives us some time to finish our round.
So on the technology side, where do you see your differentiating offering? What's unique about Chintai?
There's a number of issuance platforms out there already in the crypto space. Polymath, for example, is a big one that people will have heard of, and securities. Then you've got some of the smaller challengers like Vitalo, Security. Now, if you actually look at the breadth of offering they have, they really do vary. In some cases, for example, they all handle a form of asset issues. So that's something that's the sort of base service. Almost none of them, however, have the other side of this coin, which is secondary trading. So without that, to me, it's a highly limited service that really doesn't provide the breadth of what most digital asset issuers want, which is the ability not just to issue, but the ability to secondary trade as well. We handle all of that and the ability to do all of that. A lot of them as well, they don't have compliance properly factored into this either. When you look at the ones based on a chain like Ethereum, for example, it's extremely difficult to do that on a public blockchain of that kind of design. Most of the compliance solutions that are being talked about are off-chain solutions. They don't really have the ability to be leveraging the underlying immutability of a blockchain either. Again, because of designing this from the ground up, we have a token control protocol, a shareholder registry, all of it baked in at the underlying chain protocol level, which means that you can actually have the regulator reference and monitor the blockchain and be sent automated reporting, for example. All of that can be handled at the chain level, and that can be truly used as the golden source of information rather than having to actually sit there and rely on other centralized counterparties elsewhere to contain and reference underlying data or transaction monitor and so on. So those are some of the core aspects that we have. Not all of them also have white label technology like we do. So we're encouraging as many companies as possible to leverage Chintai to build out their own use cases, become the market makers, issuers, and so on, although we also offer issuance and secondary trading for companies that want to just leverage us and not have to do any build themselves. Quite a lot of the other platforms have got more of a centralized design like Polymath, where they're aiming to be the marketplace. They're aiming to be that central app that everyone has to use. We decided quite early on that really didn't fit in with the advantages of what we're trying to do. We're simply trying to be the engine that everybody can leverage, and it's all bound together with an underlying tech stack. Tezos is actually very impressive. It's also a DPoS chain. I think it's being quite well run. It's got a foundation that's fairly centralized, but that's no bad thing in its infancy like this, where they're investing heavily to get some decent quality commercial projects on the chain. I think that the underlying validators, the bakers, are doing a good job there too in terms of how they're managing the train with a worker proposal system. That's all good to see. The problem is that Tezos is still far, far lower performance than EOS.io, whereas the EOS.io 2.0 code base has come out, and this can handle upwards of 8 to 10,000 transactions a second at the underlying chain. And they're now looking at ways of parallel scaling this to scale this up to vastly more. It's got a protocol that's still quite slow, where reversibility times are in periods of sort of 5-6 minutes as opposed to about 70 seconds on an EOS.io chain. So, I'm quite happy with the base technology that we based Chintai off. I would say, however, that we've become very, very tech agnostic over the last 18 months. Whereas you talked to me back, when we did talk about the launch of EOS, I was very bullish about it just becoming the dominant platform. And I think I've had more of a reality check now to the idea of servicing other applications on the likes of Ethereum, for example, where they can still do the issuances on Ethereum. And there's some additional costs and benefits indeed from a proof of work based chain with that level of security and immutability. But they can, for example, reflect and have all the secondary trading take place live and cheaply on an EOS.io based chain through Chintai that embed fully in their application and still have it all on blockchain and just reflect back occasionally to Ethereum at much lower cost, but with all the performance advantages of that secondary trading and granularity still being on a blockchain. These are the sorts of design decisions that will be, again, market driven. We're exploring all of those and overall pretty happy with how our technology stacks up against the competition.
Yeah, so we had Tokeny Solutions on a show a few episodes ago, and they're building on Ethereum. So with that comes a focus in that 3 classification that I said earlier on issuance and private markets. They're not focusing on public markets. The Ethereum blockchain clearly wouldn't be able to deal with the public market, equity market like volume. So the performance issues is well recognized.
If you look at the model for DeFi on something like Ethereum, I mean, it handles high value, low transaction volume models like insurance quite well. It doesn't handle the opposite, but it's really trying to position itself, I think, related to the decentralized data source and the immutability security aspects of the blockchain as its big thing. And then it's encouraging design where a lot of that is taking place off-chain at present. I think actually we'll see how Ethereum 2.0 eventually comes out, but regardless of that, there are some good second chain solutions like EOS42 based and Tezos based, which can probably add in a lot of that additional functionality for Ethereum applications right now without them having to move off the platform by any means. And I think we'll probably see more of that interfacing starting to take place. And that's a healthy thing. You know, we're all really working for the same aim here. And I think there's no place, or there shouldn't be, for this sort of tribal, my coin is better than yours type mentality of 2016, 17. And hopefully we're all moving beyond that.
You ultimately then with the Gavin vision of multi-chain future where interoperability between the chains is hugely important, and whoever creates a new application can actually then pick and choose a certain chain for a certain function and compose it together.
There are 2 ways to look at this. The underlying chains themselves will become higher and higher and higher capacity. But I do think fundamentally configuration of those chains can be optimized quite substantially to different use cases, particularly on an industry basis. And so if you look at, for example, what we're proposing and having coming for compliance, I'll give you a good example. Let's say, Norbert, you decide to tokenize and issue out your own house for secondary trading and you want to just sell a portion of it on. Then something happens and actually it gets hacked. 30% of the tokens get just stolen on the Ethereum platform. You'd have a real problem there because there's not really any obvious recourse. And so you'd have to potentially take that out into the real world, say, look, this theft, this person doesn't really own 30% of my house. You'd have to get it reflected back on a legal level and somehow cancel that token out of the existing listing and issue a new token as the way of actually getting out of that mess. Whereas if you have it properly designed in at the chain level, where there's a form of management by the validator too, if you have a regulator or an arbitrator can make a ruling on that, they can actually make some decisions. They can freeze the underlying account. They can return the tokens back to an original holder. They can reissue them. There are real world level controls and recourse that you actually need for a market and for financial products of this nature. So this is where you have this balance between total immutability that some people think it must be the case with a blockchain versus managed immutability, where in theory, though, other changes can reverse those back via a series of decisions and effective arbitration mechanisms. And I'm still personally of the opinion that it's those sorts of models that are going to end up being inevitable and needed for a wide range of financial assets. I don't really see how we can do it any other way because we see hacks and problems occur on public blockchains with some frequency on Ethereum, and very often it's just a case of people turn around and say tough shit to them. You know, that's not how it works typically in the real financial system. There are controls and recourse in place for that.
And I have the ability to freeze accounts, which obviously from a regulatory perspective is important to have. It's important to get a license and be accepted. It takes away from this purist approach to decentralization, right? It adds a function of centralization in there, and that obviously can mushroom. What does it mean for the true vision of a decentralized marketplace?
I don't think it needs to stop the decentralized marketplace aspect. So, for example, although the initial listings of digital assets via Chintai itself will be in a more custodial, centralized exchange model, although everything will be on chain, we actually already have the built-out capability to make the entire market fully peer-to-peer. In other words, the assets remain in your own account right through until the moment of trading and go direct peer-to-peer without necessarily going through the underlying exchange at all in any meaningful sense. We have that kind of design capability too. What we're talking about though is the underlying chain that these assets sit on being configured in such a way that there is an ability for example, a regulator to actually meaningfully meaningfully regulate and enforce action against bad actors in various forms. So the problem you have when you put this on a totally immutable chain, if you want to use that chain as the golden source and actually say whatever reflects on the chain is legally the truth, you really can't do that on a public blockchain where there is no ability to handle dispute resolution. So you need that embedded in the underlying chain design, in my view. And that's one of the reasons why we're leveraging a specific DeFi chain for that. And in terms of the market launch, it's so that we can decentralize out the entire underlying markets and have countless other companies also launching additional exchanges and issuance platforms using Chintai as well. All of them bound together. They can share common liquidity in many cases too. But nonetheless, you've then still got that ability, say, for example, for the Japanese regulator to come in and be able to say, right, this is actually illegal activity. We want these accounts frozen. We want these tokens returned back to these individuals. We want to issue a fine here, etc., etc. You need those kind of additional controls at the chain level to enable that. Otherwise, I can't see how regulators would rightly accept meaningful financial activity moving onto blockchain.
And key ingredients that's always missing in many of these KYC AML activities is actually a usable digital identity on chain. Are you building your own? Are you using something that's available in the EOS ecosystem? What's your solution to that?
There is a full digital identity built in at the chain level of this DeFi chain. That is something that it's not just the initial KYC. There's an ongoing KYC process that has to be renewed over time as well. What I like about that is that right at the account level, although the underlying participants can take place with relative anonymity, there is the ability though for authorities or indeed at the chain management level for identity to be known as well. So that's also useful from an enforcement perspective. It's not intended to be a full public blockchain in the way that Ethereum is, where anybody can just set up an account. You have to go through KYC. And then in terms of access to an underlying market, you have to fit the right criteria. You might need to be from Singapore and Japan, for example, to participate in a particular kind of tokenized real estate market or bond issuance, for example. You're a US citizen or you're a US resident, maybe you can't. And those are the sorts of controls, again, by having them down at the chain level, you've got some real strengths because it saves the underlying applications having to do this themselves over and over again. It's actually quite powerful to have that done at the chain level.
And so for the trading activity to take place in an efficient way, we've seen this with Bitfinex and Tether, kind of need a stablecoin that's medium of exchange to make it easy, or otherwise you always need to have the fiat on-ramp. What's your approach to that?
We're actually exploring stablecoin options at the moment. One option is that we would actually launch one of those potentially in partnership with a number of the financial institutions and make that an asset-backed stablecoin linked to a particular either a fiat currency or a basket of fiat currencies. That's one option. Another is to leverage. We have a couple of stablecoin options that are EOS.io based, like Equilibrium is one, and that is a USD based one. In theory, it's possible to leverage that as well. So to some extent right now, you're absolutely right. It's 100% going to be required. Whether or not it's something we issue ourselves with partners as part of the market launch, or it's an alternative solution we leverage, I think we're quite open to that at this stage, and we'll have discussions with the appropriate companies as we get nearer.
So much of finance, and people call it different things, invisible finance, embedded finance, etc. But finance is going everywhere into apps, etc. So we've got people who want to put a bank in every app. We've got folks who want to make everybody a fintech. And essentially, by expansion, your technology would enable everybody, no matter which industry, to actually implement the marketplace as part of their customer interaction and customer value proposition, right?
That's exactly right. Yeah. So ultimately what it means is that any potential business can become an issuer of their own assets and also handle the secondary trading for their clients or for their customer base. And it can be embedded as seamlessly as they wish into whatever their underlying use case and front end is. So, a good example is if we look at the Telegram Open network, the entire aim of Telegram was to try and emulate the WeChat model very much, whereby commerce was now starting to happen within this chat-based interface, and they saw the opportunity to try and do something similar, which is obviously now, if your listeners are familiar, they've now abandoned the TON project, and quite how this plays out for those early investors, who knows in terms of refunds. But it was a $1.7 billion raise that they completed. Due to their ongoing dispute with the SEC, that's now been abandoned, but that really certainly isn't the end of these types of projects, and I think this is also one of the drivers, for example, behind join the Libra Association and trying to get WhatsApp properly commercialized in a similar way where commerce can take place within that. Well, to some extent, this is the same sort of thing. You're in an existing industry where you are a participant in terms of, for example, selling something like real estate, as I keep coming back to, but ultimately, another example would be any kind of timeshare or let's say music content rights, for example. Again, you've got the ability to actually far more effectively issue out music content rights and the associated income streams and handle secondary trading of that for your clients. You can just simply leverage a platform that's there and built to enable you to rapidly do it at very low cost, as opposed to potentially having to spend millions of dollars yourself building this entire thing out from the ground up each time. It's not really, I don't think, too different from the way most of the banks chose to use an off-the-shelf order management system. Very few decide to build one proprietary in-house, and it's really got some parallels with that, where you have that shared underlying functionality that's being replicated over and over. It makes no sense for companies to be doing that and replicating that effort themselves.
Final question is, if everything goes well from now 2020 into the future, what does the future look like for Chintai, and what's the path to world domination?
Well, I'd settle actually less for world domination than a really healthy industry participation. So if everything goes to plan, we'll obviously complete this Series A raise, which will be a big thing. In this current environment, it's good because it's focusing on keeping us very lean, looking at focusing on revenue generation and just innovating in general and forming meaningful partnerships. So we'll obviously complete the raise. We'll complete our entry into the sandbox and some successful testing and license issuance with the Singapore entity set up. We'll be expanding the team out to include a business development lead who will be based out of Asia. We will sign up a number of major clients within the industry, hopefully also some substantial financial institutions who will be participating in the successful market launch for both securities and bonds. They will very much be the drivers of that market. It's not intended for us to be anything other than a technical service provider for them to help maintain the underlying platform they can help deploy all of this on, and otherwise to actually see some really substantial markets start to form in a new asset class or two as well. So we obviously have talked about the tokenization and fractionalization of real estate. Great. Actually, if you look at a market like bonds, I see bonds as perhaps one of the biggest ones that's ripe for disruption, because if you look at corporate bonds, for example, and the types of bonds that can be issued right now, the issuance fees are prohibitive for many companies. The underlying banks that lead the rounds charge extremely high fees. There's a lot of associated expense with that, and it makes them as an asset class not necessarily very affordable for a lot of companies. We think that actually by moving this onto a blockchain and with the lower margin model that's possible with this could open up bonds to a much wider range of potential customers over time. I think the entire bond rating system, and the same with stocks in general, has the potential to be massively disrupted too with a decentralized rating mechanism that could be, for example, success or state weighted, and I'd like to see some innovation in those areas too, and that's something we are exploring, potentially also deploying in line with the bond markets over time, perhaps shadowing an initial rating system and moving beyond that. So I think for us, we're really looking at the next 2 to 3 years as a big one related to the successful launch of the markets, forming some really exciting partnerships and growing out those initial markets to show the potential in a jurisdiction that's dynamic like Singapore, and from that being able to expand into Japan, the US, the UK, and so on. And I think it'll be really fascinating seeing which innovative companies decide to just pick up what we built and do something really powerful and exciting with it quite rapidly now.
Super. Certainly very exciting times ahead. Best of luck for the journey. And I'm sure if we catch up in 18 months again, then we'll have a very different conversation again.
Oh, I do not doubt. Yeah, I mean, the one certainty is that, if you look at the last 18 months, is that it's almost impossible to foresee what will come over the next 18 months. I think that's the only thing I'm certain of, is that I cannot foresee it accurately, and nor can anybody else. So.
Thanks a lot, David.
Thank you, Norbert.